In 2026, a market crash could do something most people don't expect. It could make a small group of investors extremely rich, while everyone else loses money. And the difference comes down to one decision. Here's the thing nobody tells you about market crashes: they don't destroy wealth. They transfer it from the people who panic straight into the hands of the people who prepared. And if you're watching this video right now, you have a real shot at being on the right side of that transfer. Right now, markets are volatile, interest rates are still elevated, global tensions are rising, and recession probabilities, depending on the model, are hovering around levels we haven't seen in years. Major banks are warning that the risk of a correction is higher than usual. And when that happens, most investors do the exact same thing. They panic. Energy prices have been volatile, and geopolitical tensions have historically been one of the biggest triggers for sudden market drops. Not exactly a relaxing time to open your brokerage app. But I'm going to show you exactly why that might not be the problem it looks like right now. Let me take you back to March 2020. In just 33 trading days, the S&P 500 fell 34%. 34%. In 33 days. People were selling everything. Investors were pulling money out of the market at historic rates. The headlines were apocalyptic. Financial Twitter was completely melting down. And then something happened. In just over a month, the market collapsed. And just months later, it was hitting all-time highs again. The people who bought during those 33 days of absolute chaos, they made some of the best returns of the entire decade. Now go back further. 2008. The S&P 500 dropped 55% from peak to trough over 17 months. Companies worth hundreds of billions were suddenly worth almost nothing. Banks were collapsing. It was genuinely terrifying. And yet, if you had invested consistently through multiple crashes, including the dot-com crash, 2008, and COVID, your returns today would still be significantly positive, not because you avoided crashes, but because you stayed invested through them. Think about what that actually means in practice. Amazon stock fell over 90% during the dot-com crash. 90%. If you had held $10,000 in Amazon shares at the peak, it dropped to less than $1,000. That sounds like the worst investment imaginable, unless you kept buying. Because investors who averaged in during that collapse and held on through the recovery turned those positions into generational wealth. The same thing happened to Apple after 2008. The same thing happened to basically every major company that survived the crash. They all came back. And the people who kept buying quietly got very rich. That is not a motivational poster. That is 150 years of documented market data. Historically, markets tend to recover strongly after recessions. In many cases, the first year of recovery delivers some of the strongest returns investors will ever see. The pattern is so consistent it almost feels unfair once you understand it. So why do most people still panic and sell? Because their brain is literally working against them. When prices fall, everything in your psychology screams danger. It feels exactly like losing money, even though you haven't actually lost anything until you hit the sell button. Behavioral economists call this loss aversion. The pain of losing money feels roughly twice as powerful as the pleasure of gaining it. The market has basically figured out how to weaponize your own brain against your bank account. And it works every single cycle, on the same people, for the same reasons. Now here's where it gets really interesting. The smartest money in the world has been quietly preparing for exactly this moment. Warren Buffett has been building one of the largest cash positions in Berkshire Hathaway's history. Not because he's afraid, but because he's waiting. Waiting for the exact moment when everyone else is too scared to buy. Buffett has a famous line for this. Be fearful when others are greedy, and greedy when others are fearful. Right now, the fear level out there is extremely high. You do the math. Greg Abel, who took over as Berkshire's CEO at the start of 2026, now holds the largest cash reserve in the company's history. And that cash exists for exactly one reason: to be deployed when everyone else is too scared to act. That's the playbook. It has always been the playbook. The Berkshire guys aren't famous because they're geniuses. They're famous because they're patient, which in investing is basically the same thing. Instead of trying to time the perfect bottom, which almost nobody gets right, smart investors use something called dollar cost averaging. They invest consistently regardless of what the market is doing. When prices are low, you automatically buy more shares. When prices are high, you buy fewer. Over time, your average cost per share ends up lower than if you tried to time the perfect moment. During the 2008 crash, investors using this approach came out significantly ahead of those trying to find the ideal lump sum entry point. And honestly, the biggest benefit isn't even the returns. It's that it removes the emotion from the equation entirely. You stop making decisions based on fear. So, what should you actually do right now? First, stop refreshing your portfolio every hour. Seriously. Every time you check that app during a market downturn, you're feeding the exact anxiety that causes people to sell at precisely the wrong moment. The market going down is not an emergency. It is a sale. And you wouldn't run out of your favorite store just because they put up a 20% off sign. Second, if you have money sitting in cash that you won't need for at least 5 years, money you genuinely do not need in the short term, a market correction might be one of the best things that can happen to your financial future. You're not losing money. You're getting a discount on future wealth. The dollar you invest during a down market buys more shares than the dollar you invest at all-time highs. Same dollar. More shares. More compounding. That math gets very interesting over a decade. Third, stay grounded in the fundamentals. Even during uncertain periods, companies continue to generate earnings, grow, and innovate. The underlying engine of the market doesn't just stop. A falling stock price doesn't change the actual value of a business. It just means you can buy a piece of that business at a discount compared to what it cost you last month. Market crashes don't make people poor. Panic does. The crash just reveals who was prepared and who wasn't. The person who watched their portfolio drop 30% and hit sell locked in that loss forever. The person who watched it drop 30% and kept adding every month. They're the one who ends up telling the story about how they built real wealth in 2026 like it was obvious the whole time. Every crash in history came with a convincing reason why this time is different. And every single time, the market eventually recovered. There's a line often credited to John Templeton, one of the greatest investors of the 20th century. The four most dangerous words in investing are, "This time it's different." Every crash in history came with a convincing argument for why this one was special. And every single time, the market came back. Not because the problems weren't real. They were. But because economies are resilient. People still eat, build, travel, borrow, work, and invest in their future. That doesn't stop. A market crash doesn't create opportunity after it's over. It creates it while everyone is still afraid. The real question isn't whether the opportunity exists, it's whether you'll have the discipline to take it. Hit subscribe if this video changed the way you think about market downturns. Every week, we break down the financial concepts that school never taught you, and that the financial industry is honestly hoping you never figure out on your own. And if you want to go deeper on exactly how to build a portfolio that not only survives a crash but comes out stronger on the other side, the next video is right here waiting for you.